Good afternoon from the Shreveport office of Eagle Financial Management Services. It's another hot, steamy, humid Friday afternoon in
in the office.
Shreveport, Louisiana, in the office at Eagle Financial. But the markets were hot and steamy this week too, Bill. The S&P 500 today
So is our office mate.
closing S&P 500 and Dow Jones Industrial Average closing at all-time highs, up fractionally today. Market a little bit disjointed. The NASDAQ Composite falling nearly 0.5%. Russell 2000 Small Cap Index up about 0.5%. Safe havens, gold and silver were both down significantly. Silver closing at $24.92, down 37 cents an ounce, and gold busting through the 1800 level, closing at 1761, down 47 cents. West Texas Intermediate, I'm kind of surprised. Oil prices down today with the employment numbers we had, but nevertheless, down $1.06 a barrel, Bill, closing at 68.03. Natural gas, which has been up, I think, about 65% year to date, closing at 4.13, down a penny. So this is where we are on the year. Year to date, the S&P 500 through yesterday, that's with dividends reinvested, is up about 18.9%. And with today's market action, we're now up a little bit more than 19% on the year. That's almost 2 years worth of returns, coming off of a pretty good, 2020 as well. I put on here on my notes here, just looking at this morning's Wall Street Journal, really favorite income fund to give you kind of a flavor or a taste for what the bond market has done this year. We were looking at these numbers the other day. The Dodge & Cox, very large income fund, was up through yesterday 0.2%, and with bond market action today, it's going to be flat to negative, after the close. So, and why would that be? It's because we had July jobs came out today, 888,000 new jobs for July was the consensus estimate, and it came in significantly stronger at 943,000 jobs, nearly a million new jobs. And so that made bond yields, treasury yields rise pretty dramatically today. The 2-year, which has been bouncing back and forth between about 19 to 25 basis points, closing at 23/100%. The 10-year at 1.3%, and the 30-year at 1.95%. Other interesting news.
Well, let me just interject on that point.
Yeah.
It's very difficult for the Fed to justify continued support in the wake of the employment numbers that we saw and the higher inflation numbers that we are seeing. And people are starting to speak up about it. We're seeing politicians on Capitol Hill even questioning the Fed using the term inflation tax, because it sure seems like these higher inflation numbers that we're seeing are an effective tax on the population.
Yeah, and we just, with the most recent CPI reading, Consumer Price Index, we saw a year-over-year increase of 5.4%. And that begs the question, something we're seeing in today's news, coming from Washington, is the White House would like to push through a very large stimulus package, which I'm not sure, given the jobs numbers today, Bill, that we really need a stimulus package, or that we need any.
Arguably not. I think the best stimulus package is already out there, and that's called job availability.
Yeah. That's what I say.
Hey, I want to give a hat nod to our coworker Wesley. He put a Facebook post out today illustrating the absolute and relative level of government bond yields. And when we're talking about the Fed and interest rates, and as you mentioned, Jack, how bond yields moved higher. Right now the 10-year U.S. government bond yield is under 1.3%. And that is a terrifically low number. But on a relative basis, it's even crazier because there are countries like Greece, yes, Greece, with lower bond yields than America. So the implication is that the country of Greece is a superior credit risk to the United States. And then we have all these countries in Europe and then Japan that are running negative bond yields. We are in Crazyville right now when it comes to the bond market and bond yields.
Well, I need to correct you on that though, Bill, because with today's jobs numbers, the 10-year went over 1.3%, 1.305% to be precise.
Well, but precision aside, that is still a terrifically low number.
I would be well. Let's look at it this way. You bring that up. Here's a nice thing to talk through. If you look at the the annual yearbook that Stocks, Bonds, Bills, and Inflation (SBBI) that Roger Ibbotson and Associates puts out, they've tracked all this data since 1926. And the 10-year, it's called an intermediate term treasury note.
Why am I thinking of yearbook salesman all of a sudden?
Huh?
Do you remember them?
Yeah.
The yearbook salesman?
Well, here's the point. The 10-year and the 20-year, I think, have averaged within 0.1%. But the 30-year returns on these things is over 5%. I mean, the returns going back to 1926 are over 5%. Mm-hmm. Yet the CPI numbers since 1926 have averaged about 3.1. So cut it with a meat axe, Bill. You've historically gotten 2% more
over inflation
on bonds over inflation. Well, the CPI just came out year over year at 5.4, yet the 10-year is yielding 1.3. So something looks terribly upside down. And in fact, given this looks a lot like 1975 to 1980, where bond yields took off. Paul Volcker was the Fed chairman and wound up getting into a predicament of having to tighten regularly and significantly.
We also had the $6 million man and Wonder Woman. So it wasn't totally terrible during that period.
I forgot. Yeah, I remember that now. But that would put Treasury yields, if they traded off of the CPI, which they should without Fed intervention, in my view, they would be yielding more than 7%. And I don't think, here's a freebie. This is coming from me, and this is just my stinking opinion. The 10-year Treasury note at 1.3 is going to be, that is a low number that's going to be much higher a year from now. So there's my prediction. And that's based on my belief on a long-term basis. It doesn't have to happen immediately, won't necessarily. And if you bank on it immediately, you've got a good chance to lose money. But on a long-term basis, market forces determine prices and yields, not governments and central banks.
Yeah, I'll take that bet. I think we'll be higher, but not significantly higher within the next 12 months.
How much do you want to bet?
A nickel.
A nickel. Okay.
How much will that be worth?
That nickel will be worth 3 cents next year.
The big news, especially here in the Gulf South and Louisiana, our state's been looked at as kind of backwards, William, because we are. We've been and continue to be number 50 out of 50 in a number of categories. And but we made 50 out of 50 with vaccination rates, hospitalizations, Delta variant growth of infections,
Yep.
all this kind of stuff. So, this has been, it looks like India, Europe, and the UK, which were ravaged by this, this strain being dramatically more infectious, but not as lethal, but still something that's very, very troublesome with the hospitalization rates and, Louisiana not being able to perform a lot of elective surgeries again. What does this mean, for the markets? Do you continue to go with the flow, stay in the same names here with the stock? The stock market's made new highs today, Bill, and we've got major concerns about COVID-19's Delta variant. Do we stay in the same names, take equity money off the table, get defensive, get out of cyclical stocks that move with the business cycle, autos, airlines?
Well, should we talk about this or transition to sports?
We should talk about this for a little while. We'll save the sports. What about the coming infrastructure stimulus and the Fed? How does that impact this stuff? I mean, what would you say to that, Bill?
Yeah, the whole thing about the infrastructure stimulus, that's fiscal stimulus. We already have monetary policy stimulus from the Fed that's been in place for 10 plus years. This fiscal stimulus has the potential to have a big economic impact if it gets passed. And we also don't know how big it's going to be. That's still a subject of much debate on Capitol Hill. But the other part of this is that based on some early reports, we don't have the shovel-ready projects in place, and it could be years down the road before the funding actually, gets to these projects. So we may not have a real economic impact for years down the road.
I saw that there's $1 billion devoted to bridges and highways and things like that, and Louisiana is going to be allocated $337 million out of $1 billion.
Well, I mean that's about.
What's that going to do? They're going to be out there filling potholes again, I think.
That's a start.
Pea gravel.
That's a start.
It's kind of sad to me. How come Louisiana?
We're getting off topic here, but
we were. I heard an interesting conversation last night that we were the 50th. I bet Wesley doesn't know this. I should have phrased this as a quiz question. Who was the 50th state? What was the 50th state to raise the drinking age from 18 to 21?
What is drive-through daiquiris for 100?
Good answer.
Louisiana, and Louisiana capitulated because
we had to.
We were threatened to miss out on major funds from the National Highway Act for our interstates and roads and so forth. So we're getting off here. I think I was going to get to this point. In my view, we want to stay the course here and we want to rebalance. But you've got some of these names that are frothy that have run up a bunch. Excuse me. How can we have our cake and eat it too? And I thought about just looking at, this is interesting because I've had a million questions on how to play this. Taking a look at, and I'm going to preface this with, we're not interested in talking about how to profit from a pandemic or something that's been horrific. But, on the other hand, I wanted to engage in a little bit of a discussion on COVID therapeutics and vaccinations, just a few names that are really kind of front and center some of them frothy, some of them that's debatable, by the way, too. Some of them not so much, and the two big ones this year have been the messenger RNA. Moderna, that's all they do. They came out with their first product this year, and then also the German startup BioNTech. I actually looked in an account today to see that Moderna's up 630% in 11 months. Basically, it started the year at 54, and I think it closed around 412 today. I think it went a little bit higher from where I wrote it down. Now, this stock pays no dividend. BioNTech up 486% in 11 months, going from 54 to 391. I think the easy money has been made there, but I don't think these stocks, on the other hand, really trade at very high multiples. But I think there's some others, so let's just look at a few of these that I think if you had some high flying, high PE stocks, and Bill, just to go back and look at this, the NASDAQ composite is selling at 37 times last year's earnings, with the estimated PE to be 29.47 for this year. That's a very high number. That's higher than probably 90% of our economic history, at least. S&P 500 coming in at a trailing PE of 33.75. Wesley, that means that for every dollar per share that you earn, you pay $33.75. Now, the future number is 22.52, which, given where interest rates are, it's not dramatically high, but it's still higher than most of our economic history. Bill, I would point out that's because the Federal Reserve has artificially propped this up with 0% interest rates, making the stock market the only game in town and nowhere else to go. So then the Dow Industrials being the most inexpensive of all of them. This would be the index to avoid if you think the Delta variant is going to, really shut things down. I don't necessarily believe that. I don't believe it at all, really. But the Dow coming in at a PE of roughly 24 with an estimated next 12 months PE of 19.4. Okay, here are three names that I'll mention in this space to take a look at. Johnson & Johnson. The maker of the single shot vaccine. They've got huge pharmaceutical concern. It has a dividend yield of 2.4, trades at 16.6 times earnings. The maker of Listerine, Neutrogena, Nicorette, Sudafed, Band-Aids, Benadryl, Stay Free, and a whole bunch of other products. Now, this one is benefiting hugely from the vaccine, but not as much as the next two.
What is Stay Free?
Don't ask me that. Okay, Bill. Gilead Sciences. Here's one. By the way, J&J is only up 9.8% year to date, with the S&P 500 up 19% year to date. Why is that? Do you know, Bill? I'll take a stab at it. The reason is because cyclical stocks have done well this year with the coming out of the lows made from the pandemic more than a year ago. And all these names I'm about to mention are considered defensive. They make money. They make money whenever.
That's why I don't know what Stay Free is.
Oh, okay.
Yeah.
Okay, because you're a man.
Yes.
Okay. So these defensive names, they're called defensive because they always have earnings, because people are going to take drugs.
Consumer staples.
They're going to use Listerine, Neutrogena, Nicorette,
Stay Free.
Yeah, all the time, and especially Stay Freeze. I'm sorry, maybe we should stop on that one. But
So that those sales of consumer staples products don't vacillate with economic ebbs
Exactly.
and flows. People are going to continue to buy those things, and
Yeah.
that's one of the reasons for appeal, for companies like J&J, Pfizer, and others, because if there is some questions about where we're going next economically, then it sure doesn't hurt to have some more defensive plays in the mix.
we don't really want to use this show as a platform to make recommendations, but I'll say this. I think it would be hard to get hurt in any of these names that we're about to mention, and they are defensive. And in contrast to a defensive would be a cyclical stock like a General Motors, for example, that a lot of people like to buy them when they have low PEs. Then if you go into recession, they don't even have earnings at all. They lose money and you have a negative PE or one that's undefinable. That doesn't happen with these names. So the next one I mentioned is Gilead Sciences. They have a blockbuster antiviral. They're an antiviral company. They make a drug called remdesivir. It's a little bit controversial at first. Talks to some nurses and the Ochsner.
I don't even think we can discuss the effectiveness of it without being censored.
Oh, really?
Really? Yeah.
Yeah, that might be true. I wasn't going to talk about the effectiveness of it. I was just going to talk on.
It's a great drug. We just can't tell you how well it works for
really.
certain viruses.
We don't want to get kicked off of Facebook Live, but here you go. This thing has a dividend yield of 4.1%. The interest rate you get on a 30-year Treasury bond is 1.95. So you're getting more than twice. There's going to be dividend increases made there. This stock is selling at 10.4 times earnings. They just reported earnings on July the 28th. Both top line revenues and bottom line earnings, they blew it out of the park. And if you think that the Delta variant is going to have some traction, or there's going to be Lambda coming after that, or whatever the Greek letter is, this would be a stock that would likely really, really, really do well. So
discuss it with your financial professional.
Yes, it's up in line with the market, yet the PE has not escalated at all this year. And then another, Pfizer, PFE, symbol PFE. It's up as well, almost in line with the market, up 22.2% year to date. It's got a dividend yield of 3.5%, which is very nice. About twice of the S&P 500 dividend. It's trading with a forward PE of 12.8%. That PE, they've recently raised guidance. Their last earnings came out and they knocked it out of the park. So the future PE is probably more like 9 or 10. This is a huge, they have a huge product, pharma inventory and pipeline. Now, this company has a collaborative arrangement with the German company that I just previously mentioned, BioNTech. About half of their revenues came from the messenger RNA shots in the last quarter. Revenues of $15 billion, and they're looking over the next 12 months to have $30 billion in revenues just from vaccinations. This is a New York City developed company dating back to 1849. In my opinion, this stock outside of BioNTech and Moderna would be the biggest beneficiary of trouble with COVID, but also the biggest beneficiary of boosters. We're already seeing that the nation of Israel has come out and purchased Pfizer booster shots. And I'm hearing from a lot of people, including an editorial in yesterday's Wall Street Journal, about people in the medical community that are being advised to get a booster shot every 6 months. If we're headed there, generally speaking, Pfizer, in my opinion, is a very promising stock.
But I think it's also important to point out that these are not just trouble stocks. These are companies that can do well regardless of what happens.
Terrific point.
With these viruses, and they can stand on their own. But these examples that you cite, Jack, I mean, this is very illustrative of the pattern that we've seen in recent years of buy bonds for price appreciation, buy stocks for income. These dividend yields are so much higher than what you can get in the bond market. Now, granted, these are not the same. These dividends are not the same as interest payments on a bond, where an interest payment, has to be contractually made. Otherwise, there's a default that results. It's up to the board of directors to decide whether or not to make a dividend payment. But having said all that, stocks that are throwing off high cash flow and paying out high dividends and have stability to their revenue stream, quality names, they're very appealing right now.
These are stocks that you could buy and hold forever, actually.
Arguably, you could.
You could buy them and leave them alone. And I think, this is off the top of my head, William, but I think Johnson & Johnson, J&J, is a symbol, is what we call an aristocrat.
Mm-hmm. A dividend aristocrat.
Yeah, I think they've had dividend increases for something like 50 years in a row. So, that's just amazing. I mentioned one last one. If you wanted to get all of these in a package, should I give them the symbol for that? Or should I tell them they can call us?
Tell them they can call us. But how about a little explanation on the structure?
Yeah, we've mentioned this on prior episodes. We own some closed-end funds that we've liked that are deeply discounted. Some of them, the discounts have narrowed. Actually, in this case, and I would recommend this, there's a name that we own. It's only up 12.2% year to date. It is up significantly more since the pandemic, but it still commands a 13% discount to the net asset value. That means that you can buy a diversified portfolio of healthcare names. That's what this one's objective is, at a 13% discount to what the actual underlying assets are worth. And because of that, you get a juicier dividend yield. In this case, 4.5% net, 4.5%. I mean, that's half of the historical annual return that you make from the stock market. So, so I do think it's a time. I think that it's a time to stay the course. Bill, wouldn't you agree? But also, you want to continue to be in the flow. I think there could be trouble coming. I'm not terribly worried about it, right now. Economically, be a little bit more worried about it for the healthiness of people worldwide and taking precautions. I don't think the economics of this are going to be something terribly significant, although I think that's low probability. It certainly could happen.
I calculated that probability.
What's that?
It's 16.45%.
Well, 16.45. Well, I was using the TLAR approach.
Oh.
Do you know what TLAR is?
No, please tell us.
That looks about right. I learned that when I was flying B-52 bombers. Okay. So, we would say if for someone who has a balanced portfolio of 50% bonds and 50% stocks, as the market goes higher and higher, you want to continually rebalance.
Mm-hmm.
But we don't, if you're 50% stocks and 50% bonds, the bonds that we own are unconventional.
True.
We're not satisfied with 1 or 2% yields We're making significantly more than that, from our bond portfolio. Well,
On the stock side, that before we wrap this up, I really like quality in where we're at right now. Surely, there's been a lot of sizzle with speculative names, and I'm not even going to give them the time of the show. But if you're concerned at all about priciness and just general levels in the market, up tier the quality.
Well, does that mean is Robinhood quality? I'm sure our viewers want to hear you talk about Robinhood.
I'm sure they don't.
We would not call Robinhood a quality stock by any stretch of the imagination. I mean, it was priced below the range it was supposed to be anticipated to come out at $38, traded down the first day, and then went crazy with option generated trading.
And there's technical factors with the high volume of options trading in this name, and that is affecting the cash price. Without getting into the weeds on all of that, but yes, the high volume of retail option trading is affecting the cash price, and if that changes course, and it could very rapidly, we'll see the cash price come down.
If you purchase Robinhood, make sure you have a get out plan, like a 20% stop loss or something like that. So, well, Bill, sports news, the NFL kicked off last night. Did you watch the game? You didn't know? You weren't aware? Okay.
How are we doing patriotic things?
We had the Hall of Fame game last night, Cowboys versus the Steelers. It was quite boring because I don't think anybody above second string made it into the game, maybe just for a player or two. But this year's going to be different because we only have 3 preseason games. So the NFL regular season, I'm not a huge fan of the NFL, but my wife is. So we've already got tickets to go to an away Saints game, which should be fun. And then the LSU Tigers are going to be taking the field here very shortly in September. Well, we're into the last weekend of the Olympics. And interestingly, it's coming down to the wire. This is interesting to me. I think to some in our audience, it's controversial about the medal, how we do the medal count, Bill. Is there's been a lot written about this recently, because if you look at most U.S. media providers, they show the U.S. in the lead with 98 medals next to China's 79. And the Russian Olympic Committee, that's the Russian workaround, 62 medals. However, if you rank them according to gold medals, China is leading the pack with 36 golds to the United States 31, and host Japan in third with 24. So we have today and tomorrow left. It's nighttime over there right now, and the United States has to win at least 5 more golds to catch up to China. It was very embarrassing to me to watch the Chinese smoke us in the 4x100 meter relay. 10 times medalist Carl Lewis had a lot of ugly things to say about the coaching of they've won more gold medals than any nation, I think, in any event, and we haven't won a gold since 2000. So I think there's going to be some coming changes there. But TV viewership has been down for this Olympics. I wasn't sure we were even going to have it with this Delta variant taking off, and nobody in the stands and extreme temperatures on the track. But that's pretty much a wrap for this Friday afternoon.
You did fail to mention one big news item from the sports world, and that is the revelation that University of Texas and
Oh, yeah.
Oklahoma reached out and they were accepted to join the SEC. My personal view on it is nope. This is the Southeast Conference, and we're talking about schools that are clearly in the Southwest. I would like to see them revive the old Southwest Conference, and we'll give them back Texas A&M and Arkansas. And if they want to continue and invade the SEC, then I suggest that we throw out an offer like Texas, the state of Texas agrees to annex the state of Louisiana. I think that would make great sense.
That's great sense. But you know what? There's another side to that story, because I think now the games won't start changing the schedules. It won't happen until 2025. But in the meantime, the American Athletic Conference, do you know who's in the American Athletic Conference? They have reached out.
Wes can tell you.
They've reached out to the other members of the Big 12, or call it the old Southwest Conference members. Well, some of those are in the SEC now too, like Arkansas, for example. But
A&M.
And Texas A&M. Yeah, good. So those are schools like Central Florida, Cincinnati, the Naval Academy, Houston. It's a pretty good conference, but they're looking at the possibility of becoming a super conference with the remaining members of the Big 12, to combat. All this is about money and TV revenues. That's what Texas and Oklahoma felt like they were losing out to in the SEC. And I think they might think that they're going to come right in and start winning, but
well, Texas can't win in the Big 12. They're welcome to come over and not win in the SEC.
Yeah, I agree. Well, that's an interesting point. Yeah, that's and we're soon going to see this college football thing kicking off here in just a few weeks. So with that, we're going to try to have something interesting for you next Friday, and try to stay out of the heat, and have a great weekend and make good decisions, and get refreshed. And we'll see you next week.